All right, so before we jump into the charts, I kind of want to start with a quick review of where we're at. So we've talked a lot about the corn balance sheet. In the last few weeks, I've shown the WASDE report. Here's what I think is important. Um, we have an absolutely massive crop coming, and the USDA is continuing to tell us this. This is not new news. You know, they started predicting a 3 billion bushel corn carryout um, uh, last summer. I mean, it was before we ever even planted these acreages. They put out a 10-year outlook, and they predicted huge carryouts. So what we're looking at is, this is from Kansas State, right? This is off their Ag Manager webpage, and it just plots the corn price versus the ending stocks. And I just want to reiterate that if we have ending stocks above this 20% level, like the USDA is implying, then it would make sense, it would logically follow that the price of corn would fall back to the ranges it had previously been in. So we're talking about sub $3 corn, possibly even near the 250 range if this were to materialize. But uh, that's one thing. You know, what if we lose acreage? What if the weather turns hot and dry and we damage the yield? And what if we actually sell more of it than we think we're going to sell because ethanol comes back or because China comes in? Well, the reality is that if you lose 4 million acres, you cut 10 bushel an acre off the total yield nationally, so you drop it down to 168, and you beat all of your export forecasts and your usage forecasts, you still have a 2 billion bushel corn carryout, even if all three of those things materialize and come true. So I read an article yesterday that I just came out of left field that suggested that the weather we're currently seeing is correlated to 2012, and that we should have a 25% reduction in the size of this corn crop because of the weather. I'm not saying that can't happen, but I'm saying right now I just don't see it. So here's the 6 to 10 day outlook. Right now, this is through June 26th. I mean, we're getting close to pollination here, right? I'm not a grower, I'm not a producer, but what y'all tell me and what I read and understand is that between now and July 10th or July 15th, it's going to pollinate, and we got to see something that's going to dry this corn crop up. And this is not it. This is slightly cooler than normal, and this is wetter than normal. Here's your 8 to 14 day. So now this takes us all the way out to June 30th. Definitely a little bit warmer and a little bit drier, but still pretty much normal, and I would say not overly threatening to the crop. Now, I know those of us that are in Kansas and in Nebraska, I know we're dry. I totally get that. We're burning up, but we don't really matter to the corn balance sheet. And I hate to say that, but we just don't matter compared to these areas. And I think we all understand that, but we don't want to get backyarditis and convince ourselves that we're burning up, so therefore everyone is, because that's just that I just don't think that's realistic. So let's look at the 5 to 7 day. This is the 7 day rain forecast, and we're looking at Iowa and Nebraska getting a lot of rain, and most of the Corn Belt getting a little bit of drink. So if this doesn't turn much drier, then I don't think it's prudent to assume we're going to drop the size of this crop. If anything, it seems like we're headed for above trend crop based on weather forecasts and everything else that I'm reading. So now let's look at the charts. This is your corn chart of December corn. We have been hoping for a seasonal rally up into the 38.2% retracement level or the 61.8% retracement level off of the major move that started late last year or early this year down to this low. We've been hoping for that seasonal rally into this time period, and the bottom line is we just haven't gotten it. Now, the only thing that's really compelling that's out there is a hope of a little bit drier forecast and a hope that we can crawl above some level. Maybe it's this 348 level, maybe it's this 50, 52, 54 level, and we can scare the shorts that are in an near all-time record short position into covering, and that could give us a little bit of pop. I think that there's 16 billion bushels of corn hoping for the same thing and hoping that that's all going to happen. And I think that's why we keep getting these reactionary days. So if we look back at the last 7 trading days, and I'm going to zoom in on this so we can see it a little bit more clearly on your screens, okay? We start on this peak here. We got a reactionary high. 2 days later, we get a reactionary low, creating resistance and support. The next day, we tried to break below it, but we found another reactionary day, right? The following day, reactionary high, reactionary low, reactionary high yesterday, now today. So 1, 2, 3, 4, 5 consecutive reactionary days in a row where we failed to close outside of any prior day's range, and 6 out of the last 7 days have done the same thing. That is a sign of tremendous uncertainty and tremendous indecisiveness by the traders. So the bulls and the bears are in an extreme tug of war at the moment on this corn market. So now let's back out and put things back into perspective, right? If this doesn't materialize, then you just got to make decisions based on where we're at. And nobody likes it, but 340 corn or 330 corn is a hell of a lot better than 250 corn if you can hedge it. So there is downside risk in this market because there's just nothing out there that is scary to the bears to make them want to cover. And as much as I want to be a corn bull in June, we don't have the story today. So so I think the prudent thing to do here for growers is to get that downside risk parked. Recognize that it can easily make new lows, that anything can happen, and that it's very, very real. So what we've been talking a lot about and working on are, you can buy these 330 puts or 340 puts. 330s are trading for 19 cents today or 18 cents. So we've gotten a little bit more expensive. Short dated puts are not very expensive. You can buy $3 short dated September puts for 2.5 cents. You can buy short dated 310 September puts for 3.5 cents. So for those of you that don't know what a short dated put is, it is a put that expires in an earlier month, but the put trades off of the December contract. So you can buy shorter term risk protection to get through the growing season and make marketing decisions later. So what we've been doing a lot of is buying a lot of $3 and 310 short dated options that expire at the end of August. So that gets us through pollination, through the June 30 crop report, through the month of August, just in case something were to happen, and the bottom were to fall out. It buys us protection kind of to that beginning time period. And the goal is between now and then to be selling cash into strong basis levels now. And I've been saying it for weeks. My opinion is that strong basis levels should be rewarded with new crop sales, because if that carryout is 3.5 billion bushels, then basis is not going to stay strong forever. Last thing I'll say is that ethanol is recovering, but it's still only grinding about 75% of what it was and what it needs to be. So longer term, that's not really bullish for corn. We need to be grinding 100% with the carryout that we've got. All right, enough of that soapbox here. Remember, this is still a hope strategy. There's nothing out there that's going to propel it. So don't underestimate the downside here. Certainly, as a spec, we want to be selling the bottom side of this, and we want to be buying the breakout above here. We don't want to get chopped up too bad, so we want to be pretty prudent. Taking, we don't want to sell the bottom and get stopped out the top very many times. So sell the breakouts and hold tight stops and just keep doing it, because eventually it will work. One direction or the other, it's not going to be a 340 to 350 market forever. We're getting to the time period that that's going to change. All right, soybeans. Soybeans carryout situation is different than corn's. You can legitimately make a case for much lower margin or much lower soybean carryouts, and you can see a legitimate case for much higher soybean carryouts. If we move 2 million acres of corn from corn to beans, that's 100 million bushels of beans that's going to be added to that carryout, right? So that's bearish. If we get hot and dry and we collapse the yield to 47, 46, that's going to be really bullish, because that's going to shrink it. So soybeans have the opportunity for significant amounts of volatility and significant amounts of price movement. So an 840 put this morning is trading for, let me get that pulled up. It's trading for 18 cents. It was 16 cents a couple days ago. There's certainly no shame in setting a floor and forgetting it and getting it on down the road, right? If you can set a floor at a reasonable level and keep your upside open, to me, that's a very prudent decision to make, just based on the total carryout. There's no definitive chart pattern in here. We're inside our cloud, which would imply chop. The longer we can't break this upper level here of 884, 885, the more bearish it gets. Because sometimes in order to rally a market, you got to break it. So we can see a sell-off and then a reactionary low with a catapult higher if something were to change in the forecast. But for today, we just don't. That's just not out there. So you got to think we're dependent on flash sales announcement. We're dependent on something for bulls to latch onto. Otherwise, we're just going to grind lower. Wheat. The news stories on wheat just flip-flop like crazy coming out of Europe. But as of this morning, the latest news is Europe is fine. It's got more supply than they had previously announced. Russia is not going to put export curbs on through the end of the year, and they actually expect exports to increase, not decrease, which is all bad for us. And our harvest is underway, and it's a good harvest. Right, yields are good. Certainly nothing that's going to threaten that. I know Western Kansas is struggling, but the rest of the state is going to be in pretty good shape. So I don't think we're going to get a big supply shock. So I would expect this 427 level to be challenged. And if it doesn't hold, then we should move to this 418 level fairly rapidly. And if we can close it below that, I would not put it past us to move on down to $4 and give it a run for its money. The one thing that I will point out that is maybe a little hopeful in wheat is that we do have an 11, and typically on a 13 here, those tend to mark at least short-term tops and bottoms. So I think that there is a legitimate possibility that wheat could bottom here in the next couple of days. And there is a possibility that this can be a double bottom right here at the 425 level. And that could be bought. So we're going to pay very close attention to that and take a look. With this prospect of a 13 coming, I'd set basis, but I wouldn't price anything in wheat at the present moment. I'd just wait for it. It might continue to slide a little bit, but I'd wait for it and then sell it later. You got plenty of time to market that wheat crop. So wouldn't get too anxious, and definitely wouldn't be interested in doing any selling with these types of readings down here. So if you're in a short position already, I just hold it and wouldn't get too anxious about coming out of it. All right, that is everything I've got for you. I hate to be bearish, but I don't see another alternative. So if you have questions or need help getting into some of those puts to remove your downside risk, please give me a holler. And I hope you guys have a great week.